The US CPI numbers are out and markets are in turmoil. Join us today as we break down the hottest stocks, cryptos, and commodities that are affected by these numbers. We'll also be talking about higher for longer. That's the expectation of the bonds market for the US interest rates in 2023 and 24. What bonds tell us is a very different story to what the stock market told us over the last 24 hours. So let's get into it. Well, welcome back everyone to the Daily Show where we talk about markets around the world. We'll be looking at the key news, the macro data, the lead indicators, and of course, the biggest levels in the hottest stocks and commodities right now. Let's begin with the news of the CPI. So it came in kind of like some of the projections we shared in the previous video, semi-hot. It actually came in above expectations, yet the market didn't do exactly what everyone expected. The first move was false. Check mark. It hit the supply that we'll talk about, check mark, and it sold off. Great. The kangaroo that happened after that was very sneaky. And also some retail favorites were allowed to run, and I mean run huge. So what really happened? Well, it wasn't super hot, but it was expected that we would come in around 0.4%. We ended up coming in 0.5%. And that's, again, a little bit worse than market economists expected. So you would think, well, the market should sell off. Well, they didn't. But let's have a look at what the bonds market told us in comparison to the stock market. What is the storyline that's behind the current manipulation, which we probably expect is due to options expiration of this week, which we'll look at later on today? Well, first up, we have the February period. So this is the terminal rate, the highest rate the Federal Reserve is expected to get to, and the terminal rate on the bottom in terms of where they're expected to cut to before they stabilize. So the dates that we want to look at here are the 14th and the 30th, because there are some big changes here. Remember, in some ways, the 30th of December marks where we began this epic rally in technology stocks. We also know that markets trade 12 to 18 months off in the future, and that the reason why this yield curve is so important is it affects medium-term value for stocks. So where are we? Well, we're at higher and less rate cuts in terms of speed to get to the bottom terminal rate than we were as of December of last year. That's telling us to be cautious in these markets when you have a medium-term approach to where you're at. So why are markets holding where they are? Well, I believe it's a mixture of things. And the first one I want to bring up here is futures market trading. So German 40, FTSE 100, and France 40. You might say, what's this got to do with US markets? Look at the short percentage interest on CFDs at the moment. 91% of people are short the FTSE 100. 82% are short the German, and 89% are short the France 40. So there's no wonder that markets have been squeezing to the higher end when you've got so many leveraged shorts opened. It's in best interest to potentially take some profit off on those. The other thing is that we know that when markets start to get frothy, people go short on futures contracts and often go long in the options side. And that's exactly what's been happening over the recent weeks. Both large technology stocks and in the US, retail have been jumping all over options. And of course, we're hitting some of the levels that we hit during the last peaks of August of 2022. February is starting to make that game being played very strong. And we need to be very cautious here over the next coming sessions based on what we're starting to see. Now, I'm telling you that when we hit 90% on the FTSE, that's starting to get to the tip point. Generally, when it becomes so crowded on the short, something breaks and we do end up moving around. But when it's in those 60s, 70s, even 80s in terms of percentage short, it tends to squeeze pretty hard. So we're at that tip point potentially in the European markets. So what was bad about the inflation? Well, it was got to be rent and food. These are the two sticky ones. These are really all I'm focused on. I know the Federal Reserve saw some of the metrics they would want to see, and that is an argument to be made for the CPI holding us where it is. But in general, it seems like we've got sticky rent and we've got sticky food. And that could mean stagflation, or at least some people will look at it. What I see it as is higher for longer, and eventually that will have to affect stock valuations. We'll be talking more about that as we go through some of this macro data. Let's also have a look at what happened to the bonds market. 10-year bonds versus 3-month bill rates. They're becoming incredibly inverted. And I expect them to invert even more. Now, we've only ever seen one reading realistically in this read data that's worse. And in all those cases, we had recessions. So yeah, it's probably likely we're in a recession or the recession will come. And that will cause most likely, or at least before that, lower valuations on stocks. Traditionally, that's what's happened. We'll talk more about when that occurs. What about some of the other data that's more towards now? Because with macro, we can get caught up and then of course, it may happen in 3 months' time, 6 months' time. Well, that's not very easy. Well, February's traditionally, in terms of data, usually has turn points. Funnily enough, that usually happens on the 15th of February. From 1950 to 2022, we tend to see that. Now, we have retail sales coming out. Will that be the straw that breaks the camel's back? Will it be PPI? Will it just end up pushing higher and then moving more down in March or even later on this year? There will be a point where we see a dip in these markets, but the data would state that the back end of February is a time to be cautious. I'm also bringing back this chart because I think it's going to be the story of this year at some point. Now, I'm not going to tell you when, but basically ERP usually rises, and this is equity risk premium, usually rises when a recession arrives. So we do need to think about it as there's going to most likely be a devaluation of some of the investments out there due to ERP. At some point that will be taken into consideration. At the moment, everyone only talks about one thing: inflation and risk to the stock market from that, interest rates and inflation. There are other problems out there that we do need to consider, and that's one of the ones that I wanted to bring up so you keep it in the back of your mind. I'll bring it up sometimes, just in the videos, just to keep you aware of those things. Make sure to subscribe if you're interested in that type of content. So what about the volatility for the S&P? Well, we want to make sure we're actually paying attention to whether this is a time for us to attack these markets and potentially look at them. Well, of course, February mid-turn turns to be usually when we get the VIX actually spiking. Q1 and Q3, they're usually the ones that when you're talking about if you're going to have bearish bets, that's usually the time you do it. And it's traditionally very, very good. Now, that's taken from, again, a lot of data, and you can see it play out in many, many years. What about when the Fed actually does cut rates? So we know that traditionally markets actually rally into the terminal rate and then dump somewhere around the middle terminal rate to the cuts. And around 1/3 to 2/3 of the way through the cuts is traditionally where you get that perfect buying opportunity that is usually very hard to get during these recessionary or kangaroo style markets. So that's what we know. Now, if it follows the tradition of these things, then we could be in for even more annoying markets over the next couple of weeks and months. Because guess what? We're still probably 2 rate hikes away from terminal rates. So that means that when we're inverted, which we are massively inverted right now, markets tend to rally, do some cowabunga kangaroo action, and then start to drop off into, of course, the cuts themselves. Because the Fed never cuts out of the goodness of their hearts. The difference here is when yield curve is not inverted, we're based on when it is inverted. And you'll notice that that's when you tend to get those new bull markets that everyone's talking about right now and feeling it. I'm here to say one thing to every investor out there. You have to have plans when markets come down. Was there or have there been some decent purchasing prices for long-term investors? No doubt there have been. They're not too bad. Even now, based on averages, if you look at some of the higher down term kind of pitches. However, you've got to have those plans because markets are still not fully involved. Mutual funds have still not put their cash into the markets fully. Now, they tend to do so and they'll end up, maybe being late to the party, but they will do so on some dips. If we look at 2020, for an example, where they started getting wild was in September and November of 2020. They went crazy at that point because they missed the bottom. Now, that's the argument that's being made right now. They have to be in, possibly the bottom's in. Well, one of the big things about that is it's going to be a point where you're still going to get most likely a dip. Now, of course, this is speculation, but generally speaking, you do get it. Do we have one of the other bits of evidence that we like? We've got some hard data that looks pretty good. Of course, everyone on the bull side will be talking about thrust and breadth. Absolutely relative. If you're taking those data stats into stand and you also think about pre-election years and all those things, generally speaking, you would be looking at a bullish market at these periods of time. But we usually also look for defensive plays by the market. And it wasn't a day they went defensive, which is a little bit annoying if you're feeling like a bear, because utilities, staples, and healthcare were some of the worst performing on the day. Traditionally, you usually see these starting to get stacked into, and we're looking for usually 3 days, or at least 2 to 3 days, even 4 days in a row. And I like to look for 3 to 4 of rotation into defensives while we're doing some sideways, potentially even Wyckoff action. When that happens, we know what they're doing, those sneaky dogs, because when they get involved in the market, we can be effectively looking at it saying they're turning defensive, we're at a critical zone, we're at an extreme level. Okay, we can be paying attention to that. So what's the VIX doing? We'll start off with the technical analysis. Let's jump into all of this. First up, well, the VIX is doing nothing. This is usually traditionally a time where it does spike. And again, that will usually come with markets actually starting to decline. At the moment, they're in sideways limbo. What about yields? Well, this is where the big change happened. We saw the chart before. This is the terminal rate month, usually September, August. And what you'll notice, it broke out. So we actually got a breakout to a new high. Okay, interesting point. Certainly a key level in the markets moving forward. This also affected, I would say, the 2-year the most. The 2 years approaching some of the all-time highs that we reached here, or not all-time, but all-time in this rally highs, 4.884. If that continues to be there and the markets continue to go sideways or even up, pay attention. We've seen this story play out many times before. Load your SPX on your charts, put it next to it, and then have a look how markets tend to react over these periods. We've seen, again, these things play out where effectively markets have rallied. So they've rallied into these yields and then they've fallen off. And I remember this one over here where we got that huge rally. The August point, we started turning, as in yields went up. The market was going up with the yields. Well, how'd that work out? Badly, as the yields got explosive. So we do need to be very, very careful of this chart and pay attention to it. What about Treasuries? Well, some people have been arguing at the moment, and I guess I would agree with them in many ways, that if we're getting closer to the Fed terminal rate, let's call it, we think we're getting closer to the Fed terminal rate end, then Treasuries are an interesting kind of bet for some people. Now, they're not usually a trade, but we did see it hit the 61.8 fib over the last 24 hours, and that's on the pullback. So certainly a key zone for Treasuries, and I guess an enticing zone for many for those levels. What about high yield junk bonds? These are basically trash bonds versus the market. Well, we're still seeing the divergence here. We've got high yield trash bonds not loving life because of the higher rates and also risk coming back in some aspects in the bond market. And we've got the stock market saying, no, nothing to see here. Let's go to the moon. We're going to 43.50. It's all good, guys. So a bit of a disagreement there between the markets. Let's move over to, let's call it the fear hedge, the US dollar, the almighty powerful US dollar. How did it fare through the CPI number? Well, it actually went low and then broke straight back up and closed high. And that's starting to build that case of, what are these wicks? Are they the bigger players actually accumulating a position? If we see the breach out, we get above these highs, well, the next level of equilibrium should be around those 105.25s. So certainly the US dollar showing us that it has some action on it, and at the moment kind of looks bullish in terms of the way that it's presented itself, the way that it's come back, and even the way that it's then rallied through. If you notice, and you put something like a fib on this, as you're rallying through, we came back to really nice pickups. And it actually wasn't the worst CPI to trade, but you just had to trade it from a scalp level and have some of the key levels or zones fixed. Gold was definitely much more difficult. I'd say that's the hardest trade. I'm not even going to say anything other than it still remains in a downtrend for now, and we don't have strong signs of recovery yet for gold. Gold hates the yields going up. So traditionally, the negative side is the way that it's looking at the moment, and it did end up going down to those sides at this point. And of course, if the US dollar continues to strengthen, gold should suffer from that. What about copper? Remains in the range. I've obviously been negative on copper since up here, and I remain most likely negative on copper. I'd like to see it breach these areas. Maybe it's going to be core retail sales or PPI or something else that pushes us through, but a critical level for copper and certainly a range-bound market on the smaller timeframes. We move now over to US oil, still trapped within two zones. I won't much say anything else other than that, but that's what it's doing. It's still trapped. And then we move over to the one that a lot of you guys have started to speculate on. I've seen this in our private community. I've seen this in the public. I've seen everybody talking about natty gas. Now, natural gas is great and all if you get the right direction. But remember, it basically drops 70% of its value. And we're at a critical zone. Now, I've got an alert sitting down here, which I'd like to see swung. And the main reason is I'd like to see it swing come back just to show that it's kind of wiping out all these early adopters to the buy. That's the kind of style that Wyckoff came up with when they accumulate a position. And we're seeing the right starts of an accumulation. I think it's a story that will continue to play out, but we'll keep watching it as much as we can. Let's move over now to Tesla. So this was the one that was allowed to absolutely scream. Tesla was up 7.51%. And the reason I bring this up is because basically we have our extreme level. We obviously saw it sell off. We've come back to a pretty deep pullback up here. And I believe this is the least technical in some ways chart at the moment and more based on completely options. So let's have a look at the options here and see what's been going on. So there's been times in 2021 and 2020 where we saw incredible amounts of options enter into markets. And again, we're seeing that. Look at the 250 calls coming out for Tesla over this next week into the 17th. We've got 220s, we've got 210s, we've got 200s. It could be that it's in a massive squeeze, similar to what we saw with AMD and some of the actual short squeezes themselves. A lot of activity here, huge amounts of retail trade. At one point, it was hitting 13 to 15% of all of the market action. But technically, Wall Street still wants max pain sitting about 170. So if you take a 211.63 current stock read, theoretically, it would be best off if the perfect solution happened for Wall Street to actually sell this stock by the end of the week. It doesn't mean it has to happen, but you can really see the massive pressure the calls are being put on. And this stock and Nvidia are the two that are really getting hit by this. And they've been allowed to fly when others are mostly sideways. Here's an example, Apple, another favorite of retail traders, sitting in the middle. Not as much manipulation here, 0.42%, still trapped. Nothing much we can say. Got expected highs and lows, obviously based on the options. Here's Nvidia, another one, 5.43%. An AI favorite at the moment. And these is happening across the AI stocks. Remember, retail only have eyes for one thing. You guys only like one thing right now. It's AI, baby. Let's get in. We've talked about these extreme levels. And of course, we did see shorting there. That was correct. The CPI number comes in. We can basically come in neutral to it on the market. And it just ramps. Now, is this froth? Is this beginning a blow-off phase for this stock? Is it Moderna all over again and all of those other stocks that got rallied through 2021? We'll follow the story. I personally think after we got that initial reaction, which I thought was a key level, it's becoming a bit gambler. So yeah, it's options only on these types of stocks to fix your risk, in my opinion. That's of course my opinion. And you've got to look at things with, basically, can we get somehow no bias on this? Is the trend up at the moment? Yeah, of course it is. Did we have a reaction to that key level? Absolutely. Could we fly to the next level if it was able to squeeze in? I mean, it's possible. These are not stocks that I think are very easy. They're more YOLO plays at this point because you know that something weird's going on. The market wasn't up across the board, yet retail traded psycho stocks at the moment, they were allowed to fly. And you just have to believe that that could be a sucking effect of basically Wall Street saying, yes, come in, buy everything. It's all good. We'll sell you all of our stuff at these high-end prices and then rug pull them at some point over the next coming weeks. Amazon, another one, totally different. Look where it is. It's on the expected weekly options lows floating around in these levels. So basically totally different storylines depending on the stocks. It was more those AI ones that have been flying. Here's the UK 100. So we hit that 90% special figure of overall shorts. That's actually where the market can start to short. I know it's ironic, but they've squeezed, I believe, so many people to the brink. I wouldn't be surprised if so many people got wiped over the last couple of days as we broke through. See these rejection wicks? You can kind of see where people would have tried to short these tweezers. They go short, their final stop losses too bad, so sad is what Wall Street says, crushes them, and then it happens. And then you're left sitting there going, what just happened to me? Well, we've all been there, unfortunately. If you have been there, share your story down below. Help others to not make those mistakes. And I'll say, it's happened to me back in the day. I know exactly what to do. And of course, then it goes in your direction. You think, how stupid was I? Sometimes risk management procedures are the best way to go with those. CQQQ, we're at a high resistance, nothing changing there over the last 24 hours. US 30, nothing changing here. Tried to get through our little triangle, got rejected. Still no real breakout, but obviously on the rejection. QQQs in general, NASDAQ putting in these high level ranges. But it was these wild swings that we saw. And I want to look at the US 100 to kind of have a look here. So we see that the market pushes these highs narratives initially, then shorts off. There was actually some nice trading inside the NASDAQ. If you know what you're doing, anyone that's done the advanced scalping masterclass would have a very good idea of what I'm talking about there. But I want to focus on the SPX here because this is the market to watch. So we're still at extreme zone 1. While many people are saying the markets are on fire and everything's exploding, it's because they're looking at individual or some stocks. And when you actually look at the S&P 500, it's not like it's exploding. It's just floating around this potential supply zone. So we had some ideas or some plans coming into the previous session. One of the plans was sitting around these lows, and the other plan was, of course, sitting around 4163 supply. So 4163, we knew there was a technical gap, which is a small zone that wasn't filled. And then on top of that, we had supply coming off our extreme zone number 1. Now, where do you have to give up on even being a bear for the time being? Well, I believe it's if markets rally through this zone and close, then they should theoretically move to extreme zone number 2. The only case where that wouldn't happen would be a take of the top, no rejection week by the end of the day, and then all of a sudden it comes in super bearish. And I've seen some of these. I mean, look at copper on the weekly in the past. You'll see those types of things. You will be able to make a decision though. Do you even want to get involved in rallies that go from here to here? Or do you prefer to sit out of the market? Or do you prefer to be more of a scalper day trader, nimble and fast in those periods? There's a lot of decisions that you get to make. Let's have a look now at this SPY. And I put in here for the private community, and obviously I'll do it for you guys in event risk like this in the future, the expected options, highs and lows. Now we didn't hit either. Now, what that means is that market stayed within the range, which is actually what it is. We didn't hit an extreme level, but there was quite a lot of expected range coming into the CPI, and it kind of disappointed from that level. I think a lot of people straddled it. I have a feeling that was a very popular trade based on the options that we're seeing. We've got a lot of 400s, a lot of 410s, heaps and heaps of people, I believe, were straddling the market, and that's why the market stayed and went kangaroo and went mental in between. It's mostly options manipulation. Now, here's the downward trend line that we had, or the upward trend line, that's basically got tapped in the last 24 hours. Let's now have a look at the US futures, because this is where things get really, really, really interesting. So the first thing that happened was that the market tapped into our liquidity. Remember, I've put it here on the chart, that 4163. So we tap into our supply liquidity, and we actually reject that. And then we pull back through the session to the 61.8 fib. And at the moment, at the time of this recording, we're selling off in the futures market action. So have we tapped liquidity? Yes. Is this a potential short zone? Theoretically, yes. It was a short zone from a technical perspective. Is there a possibility of a final wipe? Well, Wyckoff would say yes. That's certainly a UTAD style scenario. Could this be the beginning of the short? Absolutely, it could be as well, because we see another rejection week coming through these futures. So that means that each time we've tapped these levels, we've seen rejections. What is that? It's probably the algorithms of Wall Street and Composite Man in general having a go at it. Now, do we know that down here there's some critical zones? Yes, because the market rallied off that level and we've seen some wicks there. If we end up breaching that zone, that could open up the short side. And if we do end up opening up the short side, which are the key levels that we're looking at? Well, of course, we've got the 40.23, which is certainly very interesting. And then we've got this kind of shorter zone here, which is the 396, 397. So the markets could realistically still move down into these levels and even still be in buys. But what will dictate buys in here would be do mutual funds actually start to purchase the damn market? At the moment, they're not really. They're kind of neutrally positioned as much as they can be. So it was not a great CPI result, but why could markets not move? Well, I believe it's this reason. Have a look at this third week options expiration and check it out. Well, firstly, poor puts over here. That's sad, okay? It can't go down. We've always speculated we were never going to get under 380, 375 because there was too many puts. But if we have a look at where the puts are still overwhelming on the SPY at 400 and 395. So it is not in the best market interests to push it too far down. It's also not in the market's best interest to get it too far above 410. So we find ourselves at current levels 411, end of week best expectation maximum pain 402. And that would be right in the middle at around the time when you start to get the data that starts to say, okay, well, we can potentially push down. So let's have a look at the next week. Let's look at the 24th. So how much option interest do we have? We've got 600, but there's still a decent amount of puts, but nowhere near the amount that there are at the moment in the current week. And we have those 420 calls. So the problem is every time the market goes down, everyone's willing to open up puts. And that's what's stopping this market realistically going down, even with bad news. I think it's a lot of options manipulation. I think most of you will agree down below. And this is the issue really for the Q1 part of the stock market at this stage. It means that if we do see sell-offs, there seems to be a lot of rally potential due to the puts. But it's much, much better as of next week than it is this week, just due to the sheer overwhelming quantities that are in this current week. Let's have a look at Bitcoin because maybe that doesn't have the option strikes on it as much. What's it been doing? Well, Bitcoin started to rally, which we expect it to. I'd still like to see Bitcoin kind of weaken in our green box here around that 23,000 to 23,000 kind of 500. We haven't seen it up there. It's at the role reversal zone at the moment, which is that support kind of area becomes resistance. And we're aiming for Bitcoin to basically be weak at this point. That's the general expectation because it breached our purple line here. We'll be watching it. We'll be certainly look at it. You could make arguments that it actually found a little bit of a base rally and then now it's kind of, finding that potential to move up. I certainly think that it's built some small time frame scalper day trader kind of potential. But at this point, I still think that this is where the shorters will lie if it can make it up there. And we'll check that out in the next coming sessions. So what's for now the biggest news? Well, it's core retail sales coming through. Then we've got core PPI. And of course, we've got the standard earnings season of some of those big stocks. There's so much going on in these markets. I think a lot of it's got to do with options manipulation. But really, that US 500 plan that we had with the supply, theoretically, it played out pretty well. And if markets are going to short, this is certainly one of the extreme zones that we've been seeing. If you're interested in more of this type of stuff and some of the things we've been posting over on Twitter, definitely follow us over at FX Evolution. Links in the description down below. Also, check out some of our free trading cheat sheets and resources. We will be launching as well some hard data sheets that are free once a month. So definitely check it out. Just sign up for this one over here and I'll put you in for those as well when we start launching them. Thanks so much, guys. Thank you for being a support on the channel. And obviously, it's a very tough market to navigate at this stage. The manipulation is real, and clearly there's a lot of money to be made, and they don't want to leave it on the table. Bye for now.